Hey guys, Frank Curzio here, and a lot of people are watching on TV. A lot of analysts are telling you to buy the dips. The market's cheap, and I wanted to go over some numbers for you to show you basically a simple reason of why it's pretty crazy to be buying the dips right now. Okay, I'm not a paranoid person. I've been bullish for a while. I'm a numbers guy, and when I look at the numbers, it's pretty insane. I mean, earnings drives stock prices, right? So, if you're looking at earnings and take the earnings for the S&P 500, last year the S&P 500 generated $165 in earnings. What does that mean? That means all the companies combined for the S&P 500. That's the number they came up with, $165 in earnings. So that was 2019. In 2020, it was supposed to be $181 in earnings, which is double-digit growth, right? And then the coronavirus hit. So even before the coronavirus hit, we were trading at 19 times forward earnings, the highest multiple since the credit crisis. We deserved that multiple. It was a growth market. We had favorable policy, low interest rates, earnings were growing, favorable administration, low taxes. So we had a lot of tailwinds, again, pre-coronavirus. Now, the markets fell 12%. And if we look at what Goldman Sachs said, and by the way, Goldman Sachs numbers, which I'm going to break down right now, are too conservative. So they think we're not going to see any earnings growth for 2020. What does that mean? It means in 2019 we saw $165 and we were supposed to see 181. They're saying no, we're not going to see 181 in 2020. We're going to see 165 again, right? That's flat. So if we take that number, we look at the S&P 500 at 3,100. It's around 3,100 now, depending on an hour from now, it could be up or down with today's volatility. So if you're looking at that 3,100 number, and you divide it by not the 181, but the 165, right? Which is where we're trading today and where earnings are supposed to be in 2020. We're still trading at 19 times forward earnings. And people are saying the market's cheap, you should buy it here. Let's do the reverse here, because if you look in the past where 2011, 12, 13, 14 to about 17, we were trading at anywhere from 14 to 16 times earnings, and the market was going up steady. So why weren't we getting more expensive? Because earnings were going higher. Now earnings are going lower. So we're still trading at 19 times forward earnings right now. Now, let's put this into perspective, because if you want to buy the market right now, 19 times forward earnings, we didn't grow earnings in 2019 by barely 1%, and we're not expected to grow earnings in 2020, yet we're trading at a super high growth multiple right now today at 19 times forward earnings. So to put it another way, people think, well, we could go to our all-time highs again. Sounds crazy, but that was the all-time highs with 3 weeks ago. So if the market does that, if you're thinking about buying the dips, you've got to be buying the dips thinking, okay, if you're a trader, that's one thing. But if you're buying saying, wow, the market's going to go back to their highs, if they go back to their highs, remember, earnings are not 181 anymore for the S&P 500. They're 165. So if we go back to the S&P 500 and recoups all those gains, we're going to be trading at 21 times forward earnings. Let me put that in perspective for you, okay? Give you a little background. Okay. Now I'm going to break this down. This is a Twitter account, and let's go right here because this is going to be interesting. So I'm hoping that you guys can see this and you can hear me okay. So this is a chart of forward earnings going out from about 2000 till today. So I want you to keep an eye on this line right here. So this is 20 times forward earnings, right? We traded at 20 times forward earnings over here. This is back in 2001. We traded over the 20, right? Look at this line right here. Okay, we go all the way to today. Stocks never traded above 20 times forward earnings, right? All the way since 2002. That's when they traded there. What happened when they traded that high? Look where they went. All the way down. This is the market coming down. Okay. Even if you limit the credit crisis and we go back to 2007, it's come down considerably. Let me bring it back in here. So if you're thinking about buying the markets because they're going to go to all-time highs, in order for that to happen, and again, Goldman's number of 165 is probably super, super aggressive. I think that number is going to be more in the low 150s. So be very, very, very careful about buying stocks and people telling you they're cheap, because in reality, we don't know. I mean, Apple came out and said, you know what? We're removing our guidance. They didn't say we're going to generate 50 billion, 57 billion from the 63 to 68 billion that they projected. They said, we don't know. So for someone to come on TV and tell you a stock is cheap when the companies don't know what they're going to earn is outrageous. So just be very, very careful here. Again, you're not talking to a paranoid person that's telling you to sell everything, but we've been on the sidelines. Stay in the sidelines. Okay, just because you're selling things that were expensive doesn't mean you're panicking. I don't know why panic is associated with selling. I don't know why. Anyway, that's another video in itself. But be patient here. Stocks will come in even more. We'll know by next quarter, right? We don't know what China. China is a communist country. It's still spreading there. They're saying everything's okay. They're going to report a positive GDP number, even though it's negative. You don't know what they're going to do. What we do know is the earnings that the companies are going to report in about 2.5 months. That's when we'll get the base case of how long this is going to take, how it's impacting, how they're adjusting. Then we have a picture of how we can invest in certain stocks. Right now, you're walking into a dark room, it's pitch black, and you have no idea what you're doing. You're better off betting on a horse right now if you're going to buy it. But the stock market is not cheap. It's actually more expensive right now than it was when it was all-time highs. Why? Because earnings are starting to crash. I'll report back to you guys soon. Take care.